What financial risks do I need to transfer or protect myself from? Healthcare expenses and taxes. When we are working with people who are transitioning from the accumulation phase, people at work, to the distribution phase, money at work, of their financial journey, the key risks we discuss are healthcare expenses, taxes, market risks, and longevity issues, which could be running out of money. In this section, we'll be addressing healthcare and taxes. When you are working, ideally, your healthcare expenses will be covered from a major medical insurance policy. If you work for a company that offers health insurance, it will be employer provided, usually with some cost sharing requirements by the employee. When you reach age 65, everyone is required to enroll in Medicare. If you don't enroll, you will not be eligible to receive your Social Security retirement income. If people retire before age 65, you may be able to acquire private health insurance through the state program. If you're terminated from employment before age 65, you'll be eligible for a COBRA for either 18 months or 36 months, depending on the circumstances of your retirement or termination. Medicare is comprised of Parts A, B, and D. Medicare A is for hospitalization, B is for physician visits, and D is for drugs. Easy to remember. There are co-pays and limits for reimbursement, so people generally get additional coverage to help for these expenses associated with the co-pay and limits, which is generally called Medicare Gap insurance. An alternative to Medicare is Medicare Advantage plans. Medicare Advantage plans are sometimes referred to as Part C plans or MA plans, and are offered by Medicare-approved private companies that must follow rules set by Medicare. It is important to consult with an insurance agent who specializes in Medicare to get the best advice regarding this important decision. Medicare Parts B and D charges are now earnings-based, so it's important to have a smart tax strategy in place to manage your taxable income to avoid higher Medicare expenses, which will be incurred when your income increases due to required minimum distributions on your individual retirement assets. Long-term medical care is an important financial risk to assess as people consider the distribution phase of their life. Rather than acute or short-term medical care such as hospitalization, long-term care occurs when a person can no longer perform one or more of the activities of daily living, such as feeding, bathing, and walking. This type of care is considered custodial and generally is not covered by major medical insurance. Medicare only pays for the first 100 days of long-term care, only if preceded by 3 days of hospitalization. If anyone who has experienced long-term care either directly or indirectly, it is clear that a long-term health care expense can create a catastrophic financial loss. There are strategies that will help mitigate this potential loss involving different types of insurance coverages, which can be tailored to anyone's personal financial circumstances. There are many taxes in the distribution phase of life that are not part of the accumulation phase. Required minimum distributions can increase your income tax. Surcharges of Medicare Parts B and D can increase your Medicare expenses. Your beneficiaries will pay income tax on individual retirement accounts they inherit. There are state and federal estate taxes that need to be considered. It is important to have a smart tax strategy for the distribution phase of your financial journey.